first, we have Andrew Morse. He is the Senior Vice President at Global Atlantic, a leading annuity and life insurance company. In his current role, Andrew leads a team of 14 and also collaborates frequently with various functions and customers inside and outside of the company. Great to have you here, Andrew.
Thank you.
Yes, of course. Next, we have Oren Shani. Oren is a credit advisor and certified business coach with AOF. And Oren has over 10 years of experience managing businesses and advising other business owners. He started, managed, and expanded his own business, providing disability accommodations for live events across the country, and he now helps entrepreneurs launch and grow their own businesses. Hey, Oren.
Hello, thanks for having me.
Oren, I wanted to see if you could just kick us off with an overview, or what are these key documents that business owners should have in mind?
When we're talking about financial statements, there's really three primary types of financial statements that all businesses of all shapes and sizes should be mindful of and should be tracking on a regular basis. That's going to be your profit and loss, your balance sheet, and your cash flow. And I'm going to kind of briefly talk about the differences of each. So everyone should be familiar with the profit and loss. That's kind of the most simple and straightforward financial statement. Essentially, it's just tracking all of the revenue, all of your income coming into the business, and then all of the expenses that sort of chip away at that revenue. And then you kind of, once you factor in all those expenses, whatever is left over, whatever money is left over is your net profit. That is the wealth that you generated for your business within a particular period of time. That's simply what a profit and loss is doing. It's tracking that revenue, again, your expenses against your revenue, and then whatever's left over is your profit. So let's talk about the profit and loss statement, otherwise known as the income statement. Again, this tracks your revenues, your expenses, and then whatever's left over. And what's nice about the profit and loss statement is there's a visual element to the statement, right? You can always expect the top of the page to be all those revenues, all those incomes, all that, all the money that you're making from selling your products or your services. And as you go down the page, you're starting to chip away at that revenue from all these different types of expenses that we'll get into momentarily. And so you go further down the page, and then at the end, at the very bottom level, your bottom line is your net income, right? You've chipped away all those expenses against your revenue, and then whatever's left over is that profit, that surplus, right? That you, as the business owner, get to have the fun of deciding what you want to do with that. You know, whether you want to recycle it back into the business, if you want to take some payouts from it, that's the name of the game right there. So there's a nice visual structure associated with the profit and loss that I believe makes it very easy to understand. Revenue is always at the top, and you go down the page, you start chipping away at your revenue through all these different types of expenses, and at the very bottom is what's left over. So what are the components of a profit and loss statement? So like I mentioned, as you can see through this visual, you can kind of see that structure, right? Revenues at the top, sales of your products, sales of your services, and then you start chipping away with all these different types of expenses. So you'll have things like your cost of goods sold, your direct costs, the direct costs that are associated with the revenues that you're making. An example of that would be, if you run a bakery and you sell cupcakes and cakes, your direct costs, your cost of goods sold are going to be the ingredients that you need to make those cupcakes, right? You need to spend some money to create inventory to generate revenue. And that's what we mean by your direct costs. There's a direct association between the ingredients that you need to spend money on in order to generate the sales from selling those cupcakes, right? So that's the first category of costs. And then we start going down the list and we start getting into your operating expenses, or your fixed expenses, or otherwise known as overhead. And these are more indirect costs. They're indirectly related to your revenue. So for example, rent. If you own a bakery and you're paying rent, you have to pay that rent regardless of how much revenue you're making. So if you make $0 one month, you still have to pay that rent. So there's an indirect association between that expense and your revenues. So that's what we mean by indirect expenses or overhead. And then what's left over is your net profit. There is an additional expense category here when we talk about your interest, taxes, amortization, depreciation. But I think for the purposes of this, what's really important to understand is the difference between your direct costs, your production costs, and your overhead or your indirect expenses. So let's go through a little example here. Let's talk about Blake's Brake Repair. Blake's Brake Repair, that's a little bit of a tongue twister. So we're looking at Blake's Brake Repair's profit and loss statement. So the first thing we want to look at is the time period, right? So we see two columns here. We see November 30th, 2019, and we see November 30th, 2018. So these are two consecutive years of profit and loss. And you can see kind of what we call the year-over-year sales growth. So in 2018, they generated, as of November 30th, 2018, they generated 95,000 in revenue. And then on the same date, in the next consecutive year, they generated 105,000. So there was a year-over-year growth in their revenues, right? So that's essentially what we're looking at here. We're looking at 2 years worth of revenues, expenses, and profits. So let's go down the list, right? We start from the top. The top is always your revenues, always that income that's generated. So we'll just focus on November 30th, 2019 for the purpose of this example. So we see Blake generated 105,000 in revenues. And then we start going down the list. That first expense category is going to be your direct cost of goods sold, production costs, those expenses that are directly related to generating that revenue. So in Blake's case, this is probably going to be parts. He probably purchased $12,000 worth of parts to be able to conduct the repairs to generate that revenue. So his cost of goods sold was $12,000, leading to a gross profit of $93,000, right? 105,000 minus 12,000 is 93,000. Gross profit, what we mean by that is simply just the difference between your direct costs against your revenues, right? So your gross profit is not yet factoring in operating expenses or overhead. We are just looking at the difference between Blake's revenues minus his direct costs, his production costs. Okay, so we look at your gross profit. It's a performance metric, right? It allows you to see how well your business is performing, specifically related to your direct costs and how it's associated with your revenues, right? So that's what we mean by gross profit. So let's keep going down the list. Now let's factor in those operating expenses, that overhead, right? Your rents, your salaries, advertising, insurance, utilities. These are all of those expenses that you need to spend money on to keep the lights on in your business, regardless of your revenues, right? So there's an indirect association with this type of expense compared against your revenues. So again, we're just chipping away at that revenue here. So your total operating expenses, or should I say Blake's total operating expenses in 2019 were 68,000. So we're gonna deduct that from the gross profit of 93,000. So what's left over is about 25,000. Again, we're not factoring in interest, taxes, depreciation, amortization, but bottom line is, literally the bottom line here is you have a net income, or Blake generated a net income or a surplus of $25,000. So that's essentially what we're looking at. Now, this is the Schedule C on your tax return. Now, I would imagine most of our business owners on this call are either sole proprietors or single member LLCs, I would imagine. If that's the case, and you're running a business, you will be submitting a Schedule C as part of your personal taxes, your 1040. Okay, and the Schedule C is essentially a much more complicated way of looking at the profit and loss, as all taxes are seemingly unnecessarily complicated, but that's essentially what we're looking at here is the profit and loss of your business. This is where you report your net incomes to the IRS. As such, a tax liability is created based on those profits. So just to familiarize yourself, now most of you I'm sure will have a professional or a CPA fill this out, but it's important for you to be familiar with how those net incomes are being reported to the IRS. And for you sole proprietors and single member LLCs out there, this is the form that's being used to report that. Lastly, just to kind of close out on the P&L, we want to look at 3 critical profit and loss calculations. These are, again, performance metrics. These allow you as the business owner to see how your revenues and expenses are performing against each other. So the first one that we would look at is sales growth. This is going to be expressed as a percentage. So in the example of Blake's bike repair, we saw those 2 columns, right? We saw November 30th, 2019, we saw November 30th, 2018, and we can compare those revenues against each other and generate a percentage that indicates the sales growth between those 2 periods. So that's important to look at because it clearly allows you to see how your revenues are increasing, how your sales are increasing over a period of time, right? It's important to look at that. Then we have your gross profit margin. Again, your gross profit is what's left over after deducting your direct expenses from your revenue. So we express the gross profit margin again as a percentage, and that indicates to you your performance when it specifically related to your direct costs against your revenues. And then your net profit margin is similar to your gross profit margin, but now we're factoring in all that overhead, those rents, those utilities, that insurance costs, which leads to your net profit. And we calculate your net profit margin as a percentage that tells you how well your business is performing from a net profit standpoint. And we'll talk a little bit about how these are calculated.
Thank you to Oren and to Andrew for taking us through this conversation today and answering all those wonderful questions. We will see you in the next one. Bye.
Thanks.